what exactly does risk sentiment tell us? What does it signify in the markets? And how does it change from one sentiment to another? Now, when we talk about things like risk sentiment, at its most basic level, what it signifies or what it's trying to tell us is the appetite that investors have for taking on new risk. So when we have risk on environments, that is when investors will have a higher appetite for taking on risk. In these environments, you would expect to see very typical price action among various asset classes. So when we talk about equities in a risk on environment, you would expect equities to push higher. In a risk on environment, you would expect things like commodities to push higher as well. Now, just keep in mind as a side note that commodities are more influenced by supply and demand compared to things like risk sentiment. So it's not just because the one is going up doesn't mean the other one should also go up if it's risk on or risk off sentiment. That's important to understand. But generally speaking, all else equal, you would expect commodities to trade in tandem with equities, basically moving up in a risk on environment. You would expect your high beta FX to move up in risk on as well. That means your Aussie, your Kiwi, your CAD, that's things like your Norwegian krona, your SEK, that'll be things like your Mexican peso, your ZAR, your EM currencies as well. All of them that has a high dependency on commodities, that has a higher beta to risk, is expected to move up in risk on environments. Then your safe haven FX, that's your dollar, your yen, your Swiss franc, they are expected to push lower in a risk on environment. Now, when it comes to the bond market, in regular cyclical environments with low inflation, we would expect bonds to act as a safe haven, just like the dollar, meaning that we would expect bonds to go down in risk on. But during inflationary cyclical regimes, we'll talk about a little bit more about that in a second, like the one we are in right now, here in October 2022, that means you would expect bonds to actually trade in tandem with equities, i.e. going down in risk on. So that differentiation is very important. Then when we compare the risk off sentiment, that's the exact opposite. Risk off is when investors have a lower appetite for taking on risk. In these environments, you would expect to see equity downside, commodity downside, again, keeping supply and demand in mind. You would expect your high beta FX like your Aussie, your Kiwi, your CAD, your EM currencies to push lower in risk off. You would expect your safe haven FX like the dollar, the yen, the Swiss franc to push higher in risk off. And again, in a regular cyclical environment with low inflation, we would expect bonds to act as a safe haven, meaning that in a risk off environment, we would expect them to go up. But again, in an inflationary cyclical regime like we're in right now, you expect bonds to trade in tandem with equities, meaning that in risk off, you actually expect them to go down alongside equities, and in risk on, you would expect them to go up alongside equities. So that differentiation between inflation is important for bonds. Now, in terms of the things that can change risk sentiment, they can vary greatly. I mean, you are talking about monetary policy being a trigger. Fiscal policy announcements can be a trigger. Geopolitics can be a trigger. International politics, domestic politics like elections can be a trigger. Earnings season like we're in right now can be a trigger. Cyclicality, economic data, even technicals, volatility can be key drivers for risk sentiment in the short term. That's just to name a few. Now, keep in mind that this is mostly focused on short-term risk sentiment, that daily ebbs and flows that we see in the markets. But there is another type of risk sentiment that's even more important to keep in mind, and that is what we call the underlying risk sentiment. Now, underlying risk sentiment is the current sentiment that's based on the global cyclical outlook. Now, a quick example, let's quickly take a look at these four charts. A quick example of this on these four charts. These four charts shows us the cyclical impact on various asset classes during specific economic regimes. Now, the top two environments have growth rising, and the bottom two environments have growth falling. Now, what you'll notice when you do studies like this is that risk assets in general perform much better in a growth positive environment, i.e. the two top blocks. Even better when inflation is actually falling alongside rising growth. That is your top left block. But they can still perform well in the midst of rising inflation top right, if we see growth being strong enough to basically sustain to offset that higher inflation pressure. Now, the opposite of that is also true. When your cyclical growth is slowing down, that's your bottom two blocks, it's usually a very tough environment for risk assets in general. And that gets even worse when inflation is rising while growth is falling. That's your bottom right here, much like the environment we've been in the past couple of months. So your cyclical environment, basically where growth and inflation is and expected to go, that impacts what we call your underlying risk sentiment. So are we in an expansionary environment where growth and inflation, we have a growth where you have growth rising but inflation falling? Are you in a reflation environment where you have rising growth and rising inflation? Are you in a disinflation area or environment with growth and inflation falling? Or are you in a stagflation environment with falling growth but rising inflation? Whatever one of these blocks you're in, that basically impacts your underlying sentiment, meaning that in the lower two environments, your baseline expectation for the market's underlying risk sentiment would be negative or risk off. And that means that in the top two environments, your baseline expectation for the underlying risk sentiment would be positive or risk on. So you can think of your underlying risk sentiment as the tide in a harbor. When your cyclical environment is really positive, like the top two blocks, that is when you have a really high tide in the harbor. A high tide normally lifts all boats, even the ones that are slightly, lapidated, the ones that can't really float anymore. When you get a strong enough tide, they can lift all the boats. And when the tide goes out, meaning when you get a negative growth environment, cyclically speaking, the bottom two blocks, that is when the tide goes out. And that's basically where you see everybody swimming naked, basically. So the differentiation between short-term sentiment is important. Are we risk on, risk off from a daily basis? That's why we have things like this market monitor that basically shows us where we are across major asset classes. So if I just look at this at any given second at the day, I have a very good idea of where I am tilting from a risk perspective. So taking a look at this right now, just off the cuff, I know that I'm looking at a more risk-off environment. I can see equities are struggling. I can see commodities are struggling. I can see volatility measures are rising. I can see your high beta FX is struggling. Your safe haven FX is doing better. So just a quick view of this tells me, okay, where I'm at right now, the very short-term ebb and flow is showing me a negative risk sentiment. And it might be positive, of course. But I need to be able to differentiate between these short-term daily ebbs and flows and where my underlying risk sentiment is, because it's that underlying risk sentiment that tells me what my path of least resistance will be for risk. So even though I might be seeing risk on in a short-term session based on a good earnings report tonight, my underlying risk sentiment based on, again, the cyclical outlook would still be negative. It would still be risk off because we're in a bear market, basically. So you can think of your top two quadrants as a bull market environment and your bottom two as a bear market environment. So it's important to make that distinction between the two because that'll tell us where we are from a cyclical perspective. So if you take a look at equities right now, you know that in the short term, we are looking for upside in equities based on an expectation of some positive drift in earnings. If earnings can come in really, really solid, we would expect to see some outperformance in equities. But that's very short-term based. That is not cyclically based. If you take a look at just zoom out, cyclically speaking, going back to our blocks here, we are still in the bottom right block, meaning stagflation, where you have falling growth and rising inflation. So based on that being the cyclical outlook, your underlying risk sentiment is still negative. We're still in a bear market. But short term, we can look for opportunities to take advantage of short-term pushes higher in positive risk sentiment because the market has gotten very bearish very quick. There's a couple of reasons if you go back to the videos we did last week to see why we think there could be some short-term upside for equities. But that won't change the underlying risk sentiment, which is still negative. That's still risk off. So I hope that helps with the video, with the question. As always, if you want me to do another video talking about some of these concepts in a little bit more detail, don't hesitate to let me know.